Stop whatever you're doing because this just happened. Yesterday, something historic went down. Gold crashed 8%, silver tanked 17%. In a matter of hours, the worst day for precious metals in 13 years. 13 years. The last time we saw something like this, the iPhone 5 was the hottest phone on the market, and people were still using Facebook without a hint of irony. Gold and silver ETFs dropped 14%. Social media exploded, with people screaming that it's over, the bubble popped, sell before it's too late. The same influencers who were telling you last week that silver was going to 200 are now telling you to run. And thousands of people did exactly that. They sold. At the exact bottom, at the worst possible moment. And you know what happened next? The market bounced back. Gold closed at $5,180. Silver climbed back near 100, and everyone who panicked sold just transferred their money straight into the pockets of those who were waiting with open hands and a smile on their face. This wasn't a normal crash. It was a perfectly executed liquidity trap, a wealth transfer mechanism working exactly as designed. And if you don't understand how it works, I've got bad news for you. You were the prey. I'm Carter. I've spent years on this channel breaking down how the financial system actually works, not the one they show you on the news with pretty charts and experts in ties. The real one, the one that moves trillions of dollars while you're staring at candlestick charts on your phone wondering why you're always late to the party. And today, I'm going to explain exactly what happened, who took your money, and how to make sure you're on the right side next time. Because there will be a next time. There always is. And there's one piece of data in this video that changes absolutely everything. We'll get to it. Let's talk numbers, because numbers don't lie. Experts do, but numbers don't. Gold hit an all-time high on Thursday, $5,608 an ounce, a level no one had ever seen in the history of humanity. Silver reached $120, another absolute record. Headlines were talking about an unstoppable rally, a new paradigm. This is just the beginning. And then, in a matter of hours, everything went to hell. Gold dropped to $4,941. Silver collapsed to $95. We're talking drops of 8% and 17%, respectively. To put that in perspective, it's like Apple losing $300 billion in market cap in a single morning. That kind of move. What did retail investors do? Exactly what the system wanted them to do. They panicked. I mean, it's almost poetic how predictable it is. Liquidations cascaded one after another. Anyone with leveraged positions got wiped out automatically. They didn't get to choose. Their brokers sold for them at the worst possible moment because they didn't have enough margin to weather the drop. Picture the scene. You're having a quiet breakfast, you check your phone, your 3x leveraged silver position is gone. Not down. Gone. Your broker liquidated it at 4 in the morning while you were asleep. And the best part? They charge you a fee for the favor. While you watched your portfolio bleed out, someone on the other side was buying everything you were selling. At bargain prices. With a smile. This brings us to the most important question of the day. Who ended up with your money? Because look, every sale has a buyer on the other side. Money doesn't vanish into thin air like your motivation on a Monday morning. It goes somewhere. And let me introduce you to some of the players who are waiting for this exact moment with open hands and checkbooks ready. Tether. Yeah, the crypto company. The same one that issues the largest stablecoin in the world. The one regulators have been calling suspicious for years. Turns out they've been buying physical gold at an absolutely insane pace for months. 2 tons per week. Stop. Let that sink in. 2 tons of gold per week. Over $1 billion a month in bullion. They've got 140 tons of gold stored in a Swiss nuclear bunker. The CEO, Paulo Ardoino, literally describes it as a James Bond type place. I'm not kidding. His exact words. A nuclear bunker with multiple layers of steel doors guarding $24 billion in gold bars. A cryptocurrency company owns more gold than Greece, more than Qatar, more than Australia, more than almost any central bank on the planet. Why are they doing this? Here's where it gets good. Because Arduino believes, and I quote, that the world is heading into darkness. Those are his words, not mine. The CEO of the world's largest stablecoin company believes the monetary system is crumbling and he's building a tokenized gold product to compete with the dollar. While you were panic selling paper at 4 in the morning, they were on the phone with their traders saying, buy more. While you watched the chart fall and felt like the world was ending, they saw a discount buying opportunity. Funny how that works, isn't it? Poland. The Polish central bank was the world's largest gold buyer in 2025, 102 tons. They now hold 550 and just approved a plan to reach 700. Governor Adam Glapiński explained it very clearly. Our goal is to build a portfolio appropriate for these unstable geopolitical times. Price is not our primary consideration. Do you understand what he's saying? They couldn't care less if gold is at 4,000 or 6,000. They buy, period. Because they know something you don't want to accept. That the current monetary system has an expiration date. That's not Carter, the internet lunatic who's been talking about metals for years. That's the central bank governor of a NATO country with 40 million people. Brazil buying. Kazakhstan buying. Azerbaijan buying. Turkey buying. It's like every country that understands what's coming is stockpiling physical metal while the West keeps playing casino with digital pieces of paper. And then there's the Shanghai buyers. I love this part. They're paying premiums of 12 to 13% over New York prices for physical silver. 13% more for the same metal. Why would anyone do that? Because they're smarter than us. Because they know paper and physical aren't the same thing. That the price on your screen is an agreed upon fiction. That when the moment comes to request delivery, to say, hey, I want my actual metal, there won't be enough for everyone. It's like buying a ticket to a concert you know is oversold. Some people are going to see Taylor Swift and others are going to see the stadium door from the outside. But wait, it gets better. Because this has happened before. This exact pattern played out exactly 1 month ago. On December 29th, silver crashed 15% from its highs. Same panic. Same liquidations. Same headlines saying the rally was over, it was a bubble, time to run for the exits. And what happened after? January exploded. Gold went up 30%. Silver went up 65%. The best month in 4 decades. 4 decades. We haven't seen anything like it since the 80s. Pay close attention to what I'm telling you. Despite Friday's crash, gold is still up 30% in January. Silver is still up 61% in January. The crash didn't break the rally. It's part of it. It's the shakeout that kicks out the weak hands before the next leg up. It's the exact same pattern. The December crash preceded the best month in 40 years, and the people who sold in December spent all of January watching the price climb without them, crying in the shower, wondering why this always happens to them. Why do you always sell at the bottom? Let's be brutally honest here, because otherwise this is pointless. I have a family too. I have savings too. I've made mistakes that cost me money and sleep too. I'm not telling you this from some ivory tower. I'm telling you because I wish someone had explained this to me 10 years ago instead of having to learn it by losing money. And I don't want you to go through the same thing. Retail investors lose money on these moves for 4 very specific reasons, and until you understand them, you'll keep being food for sharks. First, excessive leverage. You trade with money you don't have because you want to get rich quick. You open 3x, 5x positions because if it goes up 10%, you make 50. Great. Except when a 15% correction hits, your broker liquidates you automatically at 4 in the morning while you're dreaming about Lamborghinis. It's not a decision you make. It's an automatic execution at the worst possible moment. It's like going to the casino with borrowed money. It can work out until it doesn't. And then you don't just lose what was yours, you lose what was never yours to begin with. Second, you're watching the wrong chart. Stop. Listen to this. 90% of retail investors never look at the DXY. That's the dollar index. And the dollar is what moves metals. Almost perfect inverse correlation. When the dollar goes up, metals go down. When the dollar goes down, metals go up. Basic math that nobody teaches you anywhere. The dollar has been falling for a year. It's at 4-year lows. But on Friday, it bounced. And what happened? Metals crashed. Surprise, the pros watch the DXY like hawks. They see the dollar bounce and reduce positions before the crash. You see the crash and sell after. You're always late because you're watching the wrong asset. And here's the data point that gave me chills. I need you to pay attention. Why did the dollar bounce on Friday? 3 catalysts in 24 hours that the pros saw coming and you didn't. 1. Trump nominated Kevin Warsh to chair the Federal Reserve. Warsh is a hawk. Historically, he's supported high interest rates. The market interpreted this as less money printing in the future, less stimulus, tighter monetary policy. The dollar reacted upward immediately. 2. Trump threatened Iran with, and I quote, a massive armada ready to carry out its mission with speed and violence if necessary. Speed and violence. Not exactly diplomatic language. Maximum geopolitical uncertainty that triggered profit-taking and risk assets. 3. The government shutdown hitting at midnight on January 31st with the House of Representatives in recess. 6 of the 12 budget bills still not passed. The government of the world's largest economy about to run out of money to pay its bills. 3 news items. 24 hours, the dollar bounces, metals crash, the pros read the news in the morning, saw the DXY move, and reduced positions before the close. You saw the red candle when it was already too late, the same story repeating over and over again. 3rd, you trade on emotion, not information. You didn't know about the December pattern. You didn't know Tether was accumulating 140 tons. You didn't know China had turned off the silver tap. You were trading blind. And when you trade blind in a market full of sharks, guess whose lunch? Hint, it's not the sharks. 4th, you confuse price with value. The price of silver dropped 17% in a few hours. Did anything fundamental change? Did some magic mine appear that doubled production? Did someone invent a substitute for silver and solar panels? Did China say, just kidding, we'll export all the silver you want? No, absolutely nothing changed. The deficit is still there. The shortage is still there. The only thing that changed was the number on the screen. And you confuse that number with reality. Let's talk more about Tether because it's the craziest story in all of this and almost nobody is covering it. A cryptocurrency company buying more gold than almost any country in the world. They hired 2 of the biggest gold traders from HSBC, literally poached them from the largest investment bank in precious metals. They're building what Arduino calls the best gold trading platform in the world. Why is a crypto company doing this? Because they understand something the average Robinhood investor doesn't. That the monetary system based on pure trust is fracturing. That the BRICS countries are accumulating gold to launch alternatives to the dollar. That whoever holds the physical metal when the music stops will be the one calling the shots. Tether isn't betting on gold. They're preparing for a world where gold becomes real money again. While retail sells paper on every crash crying on Twitter, they accumulate physical week after week, rain or shine, up or down, regardless of price. That's the difference between short-term thinking and long-term thinking. And now here's China. Listen carefully because what I'm about to tell you is probably the most important news in the metals market in decades and almost nobody is talking about it. On January 1st, 2026, China reclassified silver as a strategic material. They put it in the same category as rare earths. The same rare earths they use to hold leverage over the West. Every time there's trade tension, now only 44 companies can export silver from China, and they have to meet brutal requirements. Minimum annual production of 80 tons and credit lines over $30 million. Why does this matter? Because China controls between 60 and 70% of the world's refined silver supply. 60 to 70%. The Chinese silver tap to the West is being shut off. It's like Saudi Arabia saying, tomorrow, you know what? We're keeping the oil for ourselves. But with silver, and you know what's most revealing of all? It's no coincidence that the most aggressive rally in history started exactly when these restrictions kicked in. January 1st, the controls go into effect. January becomes the best month in 40 years. Connect the dots. You don't have to be a genius to see the connection. Silver isn't just a precious metal for making pretty rings. It's a critical industrial metal. Solar panels, which China dominates. Electric vehicles that use twice as much silver as a regular car. Semiconductors. Data centers for artificial intelligence. Everything that defines the technological future needs silver. And the country that controls most of the world's supply just decided it would rather keep it for its own development. Welcome to the new Cold War over resources. This brings us to the paper market versus real metal, and this is where things get really interesting. For decades, the price of silver has been determined by futures traders on the COMEX in New York. The problem is that the volume of paper silver has always been absurdly higher than the physical silver that actually exists. The ratio reached 356 to 1. 356. For every real ounce of silver, there were 356 ounces promised in paper contracts. It's like a restaurant selling 356 reservations for the same table. Works great as long as everyone cancels. The problem is when everyone wants to dine on the same night. The system worked because nobody asked for delivery. Everyone accepted that paper was as good as metal. It was a tacit agreement. I pretend I have silver, you pretend you believe me, everyone's happy. But that assumption is failing. In the first week of January, COMEX, warehouses lost 33,450,000 ounces of silver in 7 days. 26% of registered inventory vanished in a week. 1 week. People are asking for delivery. They're saying, I want my actual metal, not your little piece of paper with promises. Imagine you work at the COMEX. You show up Monday morning, $8 coffee in hand, and you see that a quarter of the inventory was withdrawn in a week. What do? Call your boss? Play dumb? Quietly update your resume? I'd be updating my resume. The market is in backwardation. The spot price is above the futures price. That's abnormal. It's the market screaming, I want the metal now, not in 3 months, because I don't trust it'll be available later. And then there's the deficit. 5 consecutive years of structural deficit in silver. 820 million ounces accumulated that simply don't exist. Almost an entire year of global mine production that's missing. More silver has been consumed than produced for 5 years straight. And here's the trap nobody talks about. 75% of the world's silver is a byproduct of copper and zinc mines. There are no pure silver mines you can open to increase production. The price can triple, quintuple, and supply won't respond because silver comes out as a side effect of extracting other metals. Basic geology. There's no quick fix. There's no magic button to push. You can't print silver like you print dollars. Meanwhile, industrial demand is skyrocketing. Solar panels at record levels, electric vehicles multiplying, AI data centers devouring metal, supply is geologically trapped. Demand is accelerating exponentially. The math doesn't lie, and no 60-minute crash changes that math. What changed on Friday and what didn't? This is what you need to tattoo on your brain so you don't fall into the trap again. What changed? The price, the sentiment, leveraged positions destroyed, fear taking over the market for a few hours, the headlines. What didn't change? Tether is still buying 2 tons a week. China is still restricting exports. The 5-year deficit is still there. Central banks are still accumulating. The COMEX is still draining. The best month in 40 years is still the best month in 40 years. A 60-minute crash doesn't reverse 5 years of fundamentals. It just transfers positions from weak hands to strong hands, from the impatient to the patient, from the leverage to those holding physical metal, from you to them. That's how the game works. And now JP Morgan comes out saying, silver's going to fall to $50, that this is a meme trader bubble, that the market is broken and you should run for the exits. Look, I'll play devil's advocate for a second. Could they be right? Sure. Silver has gone up 264% in a year. That's a lot. 20-30% corrections are normal after rallies like this. Historically normal, even technically healthy. It's a valid argument. But JP Morgan, come on. These are the same guys who've been fined for manipulating the precious metals market. The same ones who did spoofing for years. The same ones who said gold would never break $2,000. Besides, even if silver corrects, look at the fundamentals. Look at the 5-year deficit. Look at China turning off the tap. Look at industrial demand that can't stop because there's no substitute. Look at COMEX inventories falling off a cliff. Corrections don't change the direction of the trend when the fundamentals are brutally bullish. So how do you get on the right side next time? Because there will be a next time. The pattern will repeat. There will be another crash, another wealth transfer. The question is which side you'll be on. Watch the DXY. It's your early warning system. If the dollar bounces, brace for a correction in metals. Simple as that. Don't trade crashes with leverage. Physical metal won't liquidate you at 4 in the morning. Leveraged paper will. Choose wisely. February is key. If the December pattern repeats, after the crash comes the rally. I'm not saying the same thing will happen. I'm saying watch and be ready. Watch COMEX inventories. It's the canary in the coal mine. When inventory falls, when people ask for delivery, when backwardation increases, the paper market is under pressure and something's going to give. What do? Look, I'm not a financial advisor, and this isn't investment advice. But I'll tell you what I do, and you can do whatever you want with the information. I own physical metal that I'm not touching no matter what. When the price falls, I don't care. Actually, I'm happy because I can buy more at lower prices. No broker can liquidate my physical holdings. It doesn't depend on any counterparty. It's there, in my hands. I don't trade metals with leverage. Ever. I'd rather make less and sleep well than make more and lose it all in one night. And when I see crashes like today's, I don't sell. I buy. Because I understand that strong hands are accumulating. That Tether didn't stop. That Poland didn't stop. That China is closing the tap. And that no single day move changes those fundamentals. The next crash is coming. The next wealth transfer is too. The question isn't whether it's going to happen. It's which side you'll be on when it does. This isn't a normal correction. It's a reset. Resets don't send warning letters. They just arrive. And whoever was prepared survives. Whoever wasn't transfers their wealth to those who were. I've already chosen my side. Now it's your turn. If this video opened your eyes, subscribe and hit that like button because we're going to keep breaking down how the real system works while they still let us, and share it with someone who needs to hear this before they make the same mistake thousands made today. See you in the next one.